Good morning. We're getting started a little bit late today. Thursday, April 23rd, 9:20. This is the Ways and Means Committee, as usual. We are starting our day with our committee bill on an act relating to income tax brackets and investment income. At 11, we have Kevin Chu from the Vermont Futures Project Study on Economic Momentum testifying regarding that study in relationship to this committee bill. This afternoon, we are moving the trust bill that we took some testimony on earlier, and then some more testimony on the economic development bill that we all had some questions from yesterday, particularly the fee-based stuff. This morning, we have a fun amalgamation of staff to bring a few amendments to the committee bill. And so they're taking sort of two paths. One is responding to requests from the committee and from some witnesses to lower the top rate so that we're not moving so that we're not talking about the highest rate in the country. And to better align the VIP tax to the existing federal tax that is similar to it. So Pat will take us through that. And then we have responding to questions on how will we spend this new revenue? Where will it go to? How will it improve Vermonters' lives? We have two separate amendments. They are mutually exclusive of each other, but they're both to look at and discuss. One is sort of recreating the federal health care premium tax credits that went away in the bill, Trump's bill this summer, to make sure that we're returning that money directly to Vermonters in that way. And the second one is lowering tax rates on lowering tax rates for middle-class Vermonters. So those are two mutually exclusive amendments that both spend the same amount of revenue that we are adjusting based on what Pat will take us through. So we're going to hear from Pat about that. And then we're going to hear from either Kirby or Jen next about sort of one of those amendments, and then hear from Kirby or Jen after that about the other amendment. Does that all make sense? Okay, great. Pat.
So Patrick Titchin, Joint Fiscal Office. There's credit to Sorsha on this. There should be some slides under my name on the committee's website. It's a little late getting them to her. So yeah, what I'm going to talk through right now is, so first I'm going to show you what, if we took the proposal you looked at last week, with the addition of a new top bracket and were to lower it, what that could look like, and I'll show you something for you all to discuss. There's another proposal, which when we get to it, I'll kind of explain the structure of that. And then after that, we'll talk through the proposed change to the Vermont investment proceeds tax. So in the document I have posted are some slides that you all saw last week, but I just wanted to include for reference, just because it's probably useful to sort of keep in your minds. We don't need to go through it right now, but it's in the document for you to look at. So it included the income distribution, the distribution of returns in that top 1%, how that's looked over time, and then starting to look at what share of taxes that group of people is contributing, including sort of some of the age considerations and Vermont's demographics. And then sort of the national context where the state fits in terms of what the top marginal rate is. I know I say this every time, but just looking at the number of what the top marginal rate is does not tell you everything about the state tax code. Obviously, they start at different levels. There are different standard deductions, personal exemptions, totally different policies in every state. But just a national context, this map can sort of see you or show you how Vermont slots in.
Could you go back one slide for a second?
Of course.
That 500,000 to 4451, that includes everybody making over 500,000, including those making over 1 million, correct?
Yes, yep.
Just want to make sure.
It includes over 1 million folks and yeah. Yes. Okay, so the first proposal that I'm going to talk about, which was something I just added now, was lowering that top marginal rate from what you saw last week, which was 13.3. Moving that down to 12.7. What that generates is $100 million, by our estimate. Again, just remember the effective date for this proposal right now is starting for tax year 27. So you wouldn't actually see revenue starting to come in until fiscal year 28. So again, these are the same brackets that you saw last week. The only difference that you're seeing here is that top rate has come down from the 13.3, which was equal to California's top marginal rate, down to 12.7.
Where do you see the revenues in 2027 by withholdings?
I mean, you might see a little bit of cash flow change, but not necessarily something that we would expect the bulk of the revenue to come through. But you're right, you would see some adjustments starting to happen with both the withholding tables that the tax department publishes, and also with some estimated payments potentially. One thing to remember, though, is that for a lot of these particularly higher earners, oftentimes a lot of that's not going to be wage income. So you wouldn't necessarily have that should be showing up in withholding. But those are the folks that they sort of account for that dynamic with their estimated payments. Yeah. So I guess I'll pause there maybe because I know this is sort of the first thing that you all were asked to look at. And if there are any questions I can answer about this, after this, I'm going to step into sort of what I was told might be the first option with some distribution tables, how that looks. Yeah.
About changing some of the lower and middle rates as well. Is that included here?
That's not included here, but that will be included in the next section. Yeah.
Yep. Does the tax department, I don't think this is for you, but does the tax department have data that might speak to how sensitive incomes are to the brackets? Like how much people are managing income to the brackets? Does that make sense?
I mean, I can sort of generally speak to that a little bit. So part of the 10-year tax study, which you all have had in here, there is an analysis in there that gets at sort of the one-time events that put people into this and how frequently people are actually crossing over into, being compared to their normal income to being high earners for 1 year, but going back. So there is analysis in there for that. And I had a second point that is escaping me at the moment, but if I remember, I will bring up.
The property tax credit.
It wasn't about that.
Okay.
Yeah, it's escaping me at the moment.
Well,
Sorry.
I guess the question I have is there's many ways to take income. And I wondered if there was evidence about how sensitive responsive people are, and I don't want anecdotal, I'm just, because everyone has a story. I'm just wondering in
No,
general.
you actually reminded me of what the second point was. So I do want to, I do want to just say that, when we do work through these estimates, we do account for behavioral responses. So I want to make clear, this is not a static estimate. It is assuming some behavioral responses, and what we do rely on when working through that is there is academic literature out there on, basically test cases. One example being when California added their new highest top marginal bracket and sort of what the sort of dynamic or behavioral responses to that were. So we do incorporate that into our estimates here.
And we know that there's been increased use of pass-throughs, for example, recently. In Vermont.
Yeah, I mean, and that does show up as normal income or ordinary income on the Vermont return. Yeah. Okay, so option one. So this construct is a little bit different than what you just saw. It is taking, instead of adding a new top marginal bracket, it is taking the existing threshold and bumping it up to, so you can see. Oh, sorry, these are the existing brackets. So just for reference, these are the existing ones. This is what the proposal would potentially be, in that you're taking these numbers and just increasing that top bracket to what the top bracket was in the scenario where you added a new bracket. Does that make sense? So it's just increasing the threshold for the top bracket. So a lot of that income that was between, I think it's about 300,000, 315,000 was the top, is the existing top bracket here. So all of that income between 315,000 up to 586, that's now being taxed at 7.6. So that's a scenario where for these individuals, they're going to have all of that income now being taxed at a lower rate rather than 8.75. It's now being taxed at 12.7. And then again, from the previous, I guess, proposal, maintaining still that 12.7% rate. But and then the last piece that is changing here is that very bottom rate is moving from 3.35% to 2.7%. So that change right there is having a lowering effect on tax for income in that threshold for every taxpayer.
Will you say that again about every taxpayer? I think that's somehow.
Yeah. So, you know, if you're someone making $1 million, you have $1 million in AGI or taxable income. You are going to go through each of these marginal brackets. So the amount of your income that is 0 to 84,000, that's going to be taxed at 2.7. So that shift from 3.35 down to 2.7, that's lowering the taxes on your income in that range. And then again, in that range where we increase the top bracket rather than adding a new bracket, the income within that range, that's being taxed at 7.6%, which is down from it previously being taxed at 8.75. Where the increase does happen for people is where this new top bracket starts. Right? That's the 12.7%. Yes.
What I learned when I started on this, it was right before I started on this committee, actually, from a former chair of this committee, is the idea is to make the taxes as broad-based as possible and then keep the rates as low as possible. And to help the people who are more low income with things like EITC, child tax credit, and other things like social security section, whatever. So this is doing the opposite of that, because it's putting it down to 2.7.
Well, these individuals would still be eligible for those credits you're referencing.
But isn't it going, what was it?
These are the previous rates, if you look at the screen here. And then this is what this proposal would be moving on.
So it's doing the opposite of what I learned we're supposed to do. It's going from the 3.35 down to 2.7. So that is not spreading it across the whole base and then helping the people. Is that true?
It's lowering the rate on the broadest base of income.
So, but I learned better to, when you raise a rate, to raise it from broad-based and then help with specific things like EITC. Do you remember those conversations in this committee room?
I think something that actually Graham had some of it in his slides when he talked to you all about during TCJA. It's sort of the 6 pillars that NCSL puts forward. You know, reliability, fairness, simplicity, accountability, and reliability. Yeah, competitiveness. So, you know, I think those are sort of the 6 pillars that maybe guide your sort of policy discussion.
Well, I cannot forget what I learned, and that this is going in the opposite direction. It just is.
So if, Representative Odie, if in the way that you're describing that, how, and you wanted to lower taxes for middle class Vermonters, where would you adjust the rate?
Maybe if you're going with that philosophy, you do something, not with the rate, but you would do something with an exemption or an exclusion or something like that, so that you are raising the money over the broad limit and then targeting the relief.
And that makes sense. That also, I think, creates, I think one of the things that's fun about something like the pillars of a tax system is that they're all constantly being weighed against each other. And so that would go against simplicity, right? Which is also a really important piece of the tax system. The more exemptions you add, the harder it is to really even understand who's paying and how and why. And for people to understand what their taxes are. It's one of the reasons that our American federal system is the way it is compared to, say, almost any other country in the world, like Australia.
I'll ask this, I see where you're coming up with the 100 million if you know, what's being generated when you change something. What is being generated when it's 3.35 from the bottom all the way to the top currently? And then how does that change when it goes down to 2.7?
Like how much revenue are we losing out of each bucket, each bracket?
Yeah, out of each bracket, and then also overall.
Maybe I'll jump to this slide here that shows all filers. So you can see, so this isn't exactly what your question is getting at. So I just want to point out the way that these is grouped. When you see returns in this column here, that indicates that return is showing an AGI that falls within that income range. It's not accounting for, someone in this next bracket that also has income moving through that bracket. So it's similar to the question you're asking, but it's not an exact answer to it. But you can see here, what we're looking at is that, for those, and this is all returns, but I've selected the AGI or the taxable income thresholds that associate with the married filing jointly. I have each filing status separately. So we can look at that. We can go back and look at that. But the way this ends up shaking out is that for those returns with the AGI between $0 and $85,000, this would equate to about a $27.3 million tax decrease for those folks. On average, that'd be about a decrease of $135 per return. Again, that dynamic's going to change a little bit when we look at filing status by filing status. But if we're considering all returns, and then that second bracket, which we haven't changed the rate, but we did lower the rate for those folks on their first bracket, right? Their first marginal bracket that their income moves through. That group of individuals, so about 100,000 returns, would be seeing a tax decrease of about $45 million, and which shakes out on average to about $450 per return. And then again, in that third bracket, this construct is also showing a tax decrease, again, because their income is moving through that first lower marginal bracket, about $24 million, which equates to about $740 in tax decreases per return. How does that end up being tax neutral? Well, the higher those folks in that new top bracket, that 12.7%, even though their income's flowing through that first bracket, the 12.7% is ultimately creating a net tax increase for those folks, equating to about a $20,000 on average per return increase for the 4,600 returns that we're showing here that fall into that new top bracket. So we can go back and look at each filing status separately. And you'll see that the same dynamic holds true where folks with AGI that fall within those first three brackets for each filing status, on average, are going to be showing a tax decrease. You can see for joint filers, the tax decrease starts in that low range at about $100. As you go up, it goes to about a $750 tax decrease. But again, those folks in that top bracket, which generally is, was selected by the committee to refer to the top 1%. That's where you're seeing the tax increases that offset the tax breaks lower down on the income spectrum. And that's how ultimately, this is single filers again, you see bottom three brackets are showing tax decrease, top brackets showing an increase. Separate filers, same dynamic, bottom three decrease, top increase, and then those head of household filers also same dynamic. Bottom three decrease, top increase. So that's how we get here. I guess it's very, very technically speaking, not totally tax neutral, right? It's about a $200,000 decrease in revenue overall to the state. But so that dynamic of lowering that bottom rate from 3.35 to 2.7 is in this proposal driving all of the tax decreases all the way up to, on average anyway, $586,000 in AGI.
Would it be a correct assessment to say we're basically robbing Peter to pay Paul by taxing more the 1% and giving those savings?
It's certainly shifting the tax incidence.
And how would we fit in the rating with other states if we were to do this as well?
I guess rating in what sense? There's a lot of ratings.
Well, when you showed the map of the United States.
Oh, sure. Do you want to go back to that?
Yes, where would we fit in on? Would we still be up there with?
So again, this is just showing top marginal rates. I will say that lowest rate of 2.7, I believe, I feel fairly confident in saying, I feel semi-confident in saying it would be on the lower end nationally in terms of what the lowest marginal rate is. But certainly just looking at this map here, you can see that so California is the top at 13.3, 12.7% would have us falling somewhere between California and Hawaii. Hawaii is at 11%. And then sort of looking regionally, New England, New York's at almost 11%. New Jersey's, I know I said New England, but Northeast. New Jersey's at almost 11%. I know DC doesn't count.
I have an ongoing joke.
So yeah, I mean, it would certainly, top marginal rate would certainly be on the higher end in the country.
We have a reputation for higher taxes, and we'll still have that if we implement this.
I mean, so you could say we're, taking from Peter to pay Paul and Polly and other thousands of people whose names start with P and maybe other names too. And so I think it's interesting about how we sort of, what we do in Vermont to create that reputation and to change that reputation, right? We have some of the lowest taxes for the vast majority of Vermonters. That's very appealing for, a lot of people. We never talk about that. We always just talk about the tax rate.
But the other variable that's in your map is not worked is. We had previous testimony last week about where those high income brackets start. So for Massachusetts, we know it's over $1 million. For California, I'm not sure where it is.
It's about 1.4, 1.5 million.
Okay. And New York, that's 10 point.
That I actually think is like 30 million.
30 million. So it's a big difference in terms of the amount of taxes owed by people in that 500 to $1 million range.
And that's, getting back to exactly my point, just looking at what the top rate is nationally doesn't really tell you the whole story.
Yeah.
I think that's all I have on these income tax bracket, those two proposals. If we're good with that, we can move on to the Vermont investment proceeds tax proposal. again, I've included a lot of information about the federal version. A lot of this is for reference, but I'm going to run through it again because this proposal is actually to exactly match what the feds are doing, just with a different rate. So federally, the NIT was established in effective for January 1, 2013, and it was created in part to pay for some of the costs of the Affordable Care Act. It's not dedicated revenue federally, it goes into the general fund, but it was implemented in part to fund some of the costs associated with the Affordable Care Act. It is a surtax. So you have your personal income tax return, your capital gains, dividends, your investment income. That is included in your personal income tax return as normal income, right? And so this is a surtax, so it is additive to what you're paying as in your personal income tax return, right? So the investment income tax is in addition to personal income. It gets reported on both forms. So one difference, so this language is at 4%, federally the tax rate is 3.8%, and that's levied on the lesser of net investment income or the amount of your income that exceeds your modified adjusted gross income of, if you're single or an individual filer, 200,000, married filing jointly filers, it's 250,000, and then for filing separately, it's 125,000. And so really just want to quickly highlight the only difference between AGI and modified AGI is that it just says you have to add back income that you earn from working abroad. So you can federally you can exclude up to 130,000 of foreign wages, and this is just adding that back. For the vast majority of Vermonters, MAGI and AGI are going to be the same thing. And so just to quickly highlight what it means when we say the lesser of net investment income or the amount that exceeds AGI. In this first example, you have a single taxpayer that has $50,000 in net investment income and a MAGI of $300,000. So they're $100,000 over that $200,000 threshold, right? So what you do is you're going to compare the 50,000, 100,000, take whichever one's lower. In this case, it's the 50,000, and you're going to apply that 3.8% tax rate to the 50,000. And so conversely, you have an individual who again has $50,000 in net investment income, but a MAGI of $225,000. This is single filer. So they're $25,000 over that threshold. So whereas before you were going to take the amount that referred to the investment income and apply the tax rate, in this case, because they're only over the threshold by 25,000, you're going to take that amount and apply the tax rate to that. And again, this language is at 4%, not 3.8%. So what is included in net investment income? This is capital gains, dividends, taxable interest, rent and royalty income, passive income from investments, then a couple of other, federally included types of investment income. So this language that you'll see directly matches what the federal government includes in their definition of net investment income, and also is the same as what you'll see in Minnesota for what they define to be net investment income. It does not include some of those additional add-ons that you saw before, which included some, I wish I still had the slide, but it doesn't include some of the additional add-ons that you saw, including, I think QSBS was one piece of that proposal was adding in. That's the qualified small business stock, if you remember from the miscellaneous tax bill. It had some active business income that they were adding in and a couple other provisions, but what you'll see is directly matching what the feds are defining as this type of income. And so just quickly remind everyone what is not included here Investment income does not include wages, social security benefits, unemployment pay, qualified retirement plan withdrawals as your 401ks, IRAs, you know, pension or qualified retirement plan annuities, deferred compensation plans, does not include interest from municipal bonds or funds. And then income from the sale of your primary home, life insurance, or active business income. So those are not defined in this proposal as being net investment income towards this surtax.
Do federal taxes have the same exemption for capital gains that Vermont income taxes do?
They treat it a little bit differently. There's not like the Vermont version of the exclusion, but there are some schedules that Vermont doesn't have in terms of you know, what rates those capital gains are taxed at. So it's different. But they don't have a capital gains exclusion.
Okay, but they do tax them at a lower.
At a,
Rate.
yeah, like at a varying rate, I guess is kind of a good way of saying it.
I'm just trying to figure out how the two things fit together. I think it's a little bit confusing.
Can you talk a little bit about what active business income is? What falls under that?
Yeah, I mean, if you own a business and you're active in the management of it, you know, it's like it's your job, your daily job, rather than just having shares in a pass-through entity that you don't actually like manage. You just have the shares, you're just a shareholder and receive sort of passive income from. That's kind of the difference that you can think about there. And the one thing I also want to, going back to the capital gains exclusion. So you all had this discussion a little bit when talking about the floor amendment you all had for qualified small business stock. Generally speaking, capital gains from sales of stock are not eligible for the 40% up to 350,000 exclusion. And so a lot of this investment income here, you know, also wouldn't really totally apply to the capital gains exclusion on the personal income side of things.
Can you say that again?
So stocks generally are not eligible for the capital gains exclusion on the personal income
The
side.
Vermont one.
The Vermont one, yeah. They're excluded from that 40% exclusion up to 350,000 in gains. So, and a lot of the capital gains that you'll see here will be some, you know, sales of stock. Also acknowledging that some of that will be sales of, you know, businesses that are eligible for the capital gains exclusion.
So a finer point, sales of stock in publicly traded companies.
Yeah.
The other thing that's not on there, it's just important for people to realize, it's not the unrealized gain in a capital asset.
Absolutely, yeah.
Until you sell that capital asset, you don't have that gain.
Right, because unrealized gains from a tax perspective are not income, right? Unrealized gains, well, really it only becomes income when those gains are realized. So the triggering point for that to be considered income is the selling event.
I don't even know how to make sense of that, because, I mean, going back to the number of people who were, I forget, it was a couple slides back, that there were something like 3,000 people who earn under 84, and then the really top earners, and I was looking at the proportion who are over 65 versus under 65, and there's fewer, it seems like proportionally over 65. And I'm trying to think how somebody in Vermont is earning $1 million in a given year. And do we have any sense of to what extent those people are one-time or like transitional events, or are there people who are earning $1 million every year who are over 65?
So I guess we're writing the new 10-year tax study at a very good time with a lot of these questions, because you know, and I'm sorry I don't have the exact percentage, but there is a fairly large percentage of people who have 1 year where they show a large amount of income due to often realizing gains, you know, selling a business that they've built over time. So there is a fairly large percentage of those folks, but there is, you know, I can't remember if it's over or under 50%, but there are certainly a contingent of folks who are every year earning high income amounts. And I say that with, again, just stressing, there's also a large contingent of people for whom it is sort of a 1 or 2 year event. And I can pull that out of the last tax study we have. Of course, it's 10 years old, but I can get that to you.
I feel like I've heard two different perspectives on this over the years. And I think they sometimes get conflated, and I was hoping you could help me pull them apart. So there's folks who once in their life sort of cross that threshold. And then I've also, I think, heard over the years that some people's income just sort of goes back and forth over the threshold throughout their life. So it's not the same people, but they tend to hang out sort of near that line, and they're just bopping back and forth because that's like how income
Market
works, right?
flows, yeah.
Market flows, et cetera. Which to me is, in terms of the storytelling that I think we're all attaching to all of this, those are two very different things. Do you have any sense of that? How to differentiate those two? Since
Yeah, I suppose, I mean, there's certainly going to be situations where, for the folks who are bopping around a little bit, let's say, they work in an industry where they have a relatively high salary, so their wage income sort of sets a reasonably high floor for them. It's them including maybe a partner if they're married, filing jointly. And so it sort of sets like a baseline for what their income is going to be. But, because they're relatively high earning individuals, they may have the means to, buy rental properties or invest in the stock market, receive other types of income that are outside of sort of their earned income. Their earned income it's a tax definition, being income from actively working. So, I think that sort of could be sort of a profile of someone who might sort of hover around, having a reasonably high base of income through their work, but also having some, I think sometimes people refer to them as side hustles or whatever. Again, they could be purchasing rental property and receiving rent income. They could have stocks with dividends or selling capital gains. So I think that's sort of one profile. And again, this is all kind of narrative, right? And then the other just being, I think the one I hear about the most is someone who has, in 1980 started a business. They've worked at it, built it, grown it their whole life, and
received income from
it, of course. Yep. And then they're ready to retire, and sort of this business has turned into their retirement plan, right? And so from the sale of that business, they're going to have that one-time event that you see people have maybe once, twice in their life when they really have that spike in income. So that could kind of be a profile of sort of the opposite side. Again, all narrative, anecdotal kind of.
Thank you. Yeah, Representative Burkhardt has a question inside the computer, and then Representative Brannigan, and then we're gonna look at the healthcare language. Bridget? You are muted.
Yes, I'm sorry. I was trying to unmute. I had the screen all